Hey, everybody. Today, I'm going to come at you kind of hard, and I might say some stuff that you don't want to hear, but that's okay with me. As long as you hear it and you digest it, I will have considered this video a success. Poker tubers, in my opinion, some of them, not all of them, have this weird, kind of annoying little habit of saying, this card is really investable, or what should you invest in Pokemon? But I'm not an investment advisor. Tee hee hee. Don't take this as investment advice, but I made $20,000 off this one card. Okay. Well, let's clear this up. I'm not a professional investment advisor. This isn't professional advice. What this is advice from up here. I'm going to try and condense and distill all of the investment advice that I've learned and been told and watched and heard over my lifetime into a short, kind of easily digestible form. And at least in my opinion, this is some of the best advice that anybody at any point in their life could get. If you disagree or you have something to add, please put it in the comments down below. To begin with, my first piece of, I don't know if you want to call it brotherly advice, whatever you want to call it, is nothing to do with Pokemon or trading cards. Okay, so let's get that out. Let's push Pokemon to the side because, believe it or not, that's at the bottom of the list. That is the last thing that you should be considering when considering investments. When you build a house, you start from the basement. So let's start from the basement. The very first thing, in my opinion, that you should be doing to invest is invest in yourself, which means education. Find a marketable skill or a lucrative profession and pursue that. I don't care if that means school, college, associate's degree, an online course. However you take that to mean, pursue that. It doesn't have to be the traditional 4-year master's PhD road. It doesn't have to be that. It could simply be like an apprenticeship. Maybe you want to be a blacksmith and you want to be an apprentice in a blacksmith shop. I don't know. It doesn't have to be traditional, but the very first thing you should be doing is investing in yourself. Before you start talking to me about Charizards, I want to know that you've invested in yourself. Second, pay your debts. That investment that you made in yourself, if it was school, if you incurred debts while doing that, pay them off. You should not have any credit card debts. You shouldn't have any student loans, any kind of payday loans, anything like that. Hard money loans, nothing. Pay your debts. Third, and these two are interchangeable in my opinion, you could either fund a traditional retirement account. Now that you've invested in yourself, you have a lucrative career path, you're on your way to maximizing your earning potential throughout your lifetime. You can either fund a traditional retirement account, and that is in the form of like a Roth IRA, 401k. If you can get an employer matched 401k, go all in on that. Maximize the employer contribution. I don't care if you have to live in a cardboard box. Maximize your employer contribution. And I know when you're like 20, you're like 18, you're like 25, it's like, well, who gives a shit about this stuff, man? I want my Pokemon cards. I want that fast money. I want that Lamborghini lifestyle. When you get to my age and you've got kids and you're starting to think about seriously about retirement, it matters. And I'm in my mid 30s. The time difference between your mid 20s and your mid 30s. And I know this is cliche and trite and really cute and all the old boomers say this stuff, but it's going to happen. You're going to go to sleep one day and you're going to wake up in your mid 30s. Okay. I promise you, you're going to go to sleep. You're going to come home from the club. You're going to be drunk. You got a new girl, with you. You're going to go to sleep that night and you're going to wake up with 3 kids in your mid 30s with all kinds of mortgages, all kinds of businesses. It's going to happen. It's going to happen fast. It's going to come at you hard, just like I'm coming at you. So you can either do that. You can fund your traditional retirement account, or you could FHA your first property. And that's my suggestion. If you don't have to FHA your first property, you can go with the traditional loan. I don't personally know why you would do that right off the bat, but you can get away with a 3.5% down payment. Don't overextend yourself on your first property, on any property for that matter, but don't overextend yourself. Get a mortgage payment that is going to fit comfortably within your monthly payment. Don't go after that $500,000 house if the mortgage payment is going to be, I don't know, $2,500 a month and you're making $4,000 a month. The bank might approve you. They might be willing to give it to you, but think for yourself. Can you reasonably afford that? You should be able to reasonably afford your monthly mortgage payment while paying your utilities, any kind of continuing education that you might want to, pursue, and also while actively funding your retirement account, because that has to be going at the same time that you're making your mortgage payments. So I need to collect myself. Now that we've gotten this far, you've made it. Okay, you've gotten to a place where most adults have a hard time getting to. You've invested in yourself. You are educated in the field, the profession that you want to be educated in. You're on a career path to maximizing your income. You've paid off your toxic debts. You don't have any credit card debt. You don't have any student loans. You don't have any hard money, payday loans, nothing that's going to just suck the life force out of you. You've started to fund your traditional retirement account, and you should be on a path to having it fully funded by your desired retirement age. You've got your first property, the property that you live in. By all accounts, I would say by a large percentage of the population, you're a success. You've made it this far. You've succeeded. Pat yourself on the back. Congratulations. So what's the next step here? And it starts to get a little bit more dubious, but in my opinion, the next step is you could choose your own ending. This is like one of those choose your own ending books, and you have a few different paths here. You can pay off your FHA mortgage loan, which is, you'll hear different opinions on this stuff. For some people, that is an ideal way to go forward, to get rid of that monthly mortgage payment and free up that capital. So if that's the way that you choose to go about doing it, that's a perfectly acceptable way to do it. Some people will say, like, you have a 3.5% mortgage, you have a mortgage at 3.5% interest. Why wouldn't you just take that money that you would normally put towards that mortgage, put it in the stock market, that's returning 10%. And so what you get, that you get to collect the 6.5% difference. That's very valid. Okay. Some people would just value not having that monthly mortgage payment, having a house that's paid for and secured over that extra 6.5%, 5.5%, whatever it was. Or if you don't want to pay off your mortgage, you could, and this is assuming that you want to keep advancing and pushing forward, forging the trail, and you don't want to just kind of rest on your laurels and get comfortable. You can HELOC, cash out, refinance, or sell. Trade up into a new property, use your equity into a more expensive house. Not a huge fan of that. HELOC or cash out refi. I can see the merits in doing something like that. That has to be done carefully. That's not just, you're not Meet Kevin. Maybe you want to be Meet Kevin, but that's a road with a lot of precarious pitfalls that might not be apparent until you're sitting in the bottom of one of the ditches. So be careful. Or you can use your discretionary income that's left over to invest in the market, which is, I think, a road that most people end up taking. And it's a viable road to take too. So let's talk about investing in the market. And remember, we haven't gotten to Pokemon cards yet, okay? We are still quite a ways away from Pokemon cards. You're not an accredited investor, okay? I don't know who you are, but I'm assuming at this point you're not an accredited investor, which means I don't remember what the criteria are for being an accredited investor. Something of like earning $250,000. No, you have to have $250,000 invested in the market, and you're earning $250,000 a year or something. I don't know. It's not just a term that you can throw around. There's a specific definition. If somebody says I'm an accredited investor, that means that they've met the specific definition of that term, and it means something to Wall Street and the SEC. That's not playing around. That's an important distinction. So, assuming you're not an accredited investor, just buy into like the SPY. Just try and track the index funds, buy a mutual fund, buy an ETF, buy a REIT. Let somebody else whose job it is to accrue money, let them handle it. Because it's just going to be the easiest way to get the returns and not have to spend all day, every day analyzing companies. And I would caution against options. Don't do options. Trust me, don't do options. I've done a lot of options. I've traded a lot of options in my life, and I have, over my lifetime, I have a positive record when it comes to trading options. I think I'm up something like 10 or 15% overall throughout all my trades on options. So it has been successful for me, but the risk and the amount of stress and time it takes, to me personally, is not worth the reward. Because trust me, you will forget about that cute little SPY put that you bought that one day that was like $5 outside of the strike. It'll get executed on you, and your life is going to flash before your eyes when you wake up the next morning, you open your trading account, and you're now short 100 shares of the SPY, and you're $500 underwater on that short position. And if you don't know what I just said, if you have no idea like the context of that sentence that I just said, stay away from options, or at least do a lot of research before you buy them. Because that sentence that I just said, if you have any idea about options, you should be able to understand that sentence. But if you want to, let's say you want to play with the big boys. Let's say you're like, screw it. The mutual funds, the SPY, the REITs, that stuff's just not fun. I want to buy shares in specific companies. Okay, you can do that. That's a lot of people are successful in doing that. And it's a very viable investment strategy, but take some time to learn how to evaluate companies. Do your research. Don't jump in feet first. You should be reading books like A Random Walk Down Wall Street and The Intelligent Investor and blah, 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 blah. These are things that 1,000 other people have said before on YouTube. This isn't groundbreaking material. So now that you've thought about the market, maybe you're dabbling with the market. Are we at Pokemon cards yet? Nope, we're not there yet. The next thing that I think you should do is you should look at maximizing your earning potential, or starting a business. Can you get into some sort of continuing education? Do you need to change career fields? Has your career stagnated and there are opportunities in front of you to change careers and maximize your earning potential? Or start a business? Can you do a side hustle? Can you drive for Uber Eats, or do something in the gig economy? Can you start a business? Can you nail down distribution for Pokemon cards? Can you nail down distribution for, I don't know, children's clothing? Who knows? But look at starting a business to earn extra income. Now that, and this to me, this is all the foundation. These are all the cinder blocks that we put in the basement. Now that we have the basement completely built, now we could start talking about alternative assets. And yes, that includes Pokemon cards. Now that you're on track to fully fund your retirement by your desired age, you have a house with a reasonable amount of equity, you're so well invested in the market that you have excess capital and dividends are being paid to you, and you're just like, you know what? I'm at the point where I have so much extra capital that let's see if I can't make a better return somewhere else than in the market. Let's start talking about alternative assets. And this is kind of a goofy area, because when you start looking and assessing alternative assets like Pokemon cards, maybe art, what you're really looking for is a way to preserve wealth. You're not looking for unlimited upside potential. The main thing, and this really goes with all investments, you should be assessing downside risk. How much money and how likely it is that you are going to lose whatever investment that you put in. If I buy one share of Microsoft, I don't remember what it's trading at now, maybe like around $200. If I buy one share of Microsoft at $200, how likely it is that Microsoft is going to close its doors tomorrow and I'm going to be out that $200. If I buy one Charizard for $1,000, how likely is it that Charizard is going to be worth $500 in a week? That's assessing downside risk. And you want to mitigate your downside exposure whenever possible. Don't worry about the upside potential. You should not be even considering the idea that this box of evolutions is going to be worth $100,000 in 6 months and I'm going to be rich. That's not the thought that you have in your mind. Get it out of your mind. What you're thinking about is, if I buy this box of evolutions, how likely it is that this box is going to be worth half of what it's worth now in 6 months. That's downside exposure, and you should be mitigating that. And if you do enough due diligence, if you spend enough time thinking and researching about investments, if you've done enough to mitigate your downside exposure, the upside potential will follow. Things with limited downside risk have a much higher upside potential than things with a lot of downside risk. And believe me, I know it's like penny stocks, right? I could buy this penny stock for 1 penny a stock. I could buy 100,000 of them. It could move up to 2 pennies a stock, and I would have $200,000. Well, yeah, that's true. But how likely is it that the guy before you had that exact same thought, and he's just waiting for you to sink your $100,000 into that penny stock before he cashes out with his $200,000? That's the question. And if you have the answer to that question, then move forward with your investment strategy. But if you don't have the answer to that question, spend some more time researching. To wrap this up, to conclude this all, the point is you need to know what path you're on and where you are on that path. Okay. Are you a hobby collector in Pokemon? Well, then buy whatever you want. Don't even listen to the guys talking about price tags. It doesn't matter to you. You're buying cards because they're cute, because you like the way they look. Are you an investor in Pokemon? Should you be an investor in Pokemon? Are you in the place in your life where it's even advisable for you to be considering alternative assets as investments? Like I said, I told you I was going to come at you hard in this video. Hopefully you stuck with me to the end. This is all coming from a place of peace and love, because I want to see people, exceed and thrive in life and be the best that you can be. I don't like seeing people who are, on precarious footing when it comes to financial situations. And, I want to surround myself with people who are knowledgeable and comfortable and living their best lives. And that's really, this is more of like a selfish video where it's not like I'm trying to help you. I'm trying to help myself. Okay. By surrounding myself with people who aren't worried about money, who are financially literate and in sound positions, and I get to live a better life too. So, if you want to take out the altruistic part of this video, just think of it as this is a selfish video on my part. I'm trying to help myself through spreading a little bit of knowledge. Let me know what you think about the video in the comments section down below. Like I said, I do get annoyed sometimes when I see the PokeTubers go, this is investable, or this card, this isn't investable. Tee-hee-hee, I'm not an investment advisor. It's like, fine, let's lay it all out. Let's put our proverbial cards on the table, if you will. Okay, let's put the knowledge out there, and then we could start, talking about investments in Pokemon. Thanks for watching. As always, I will catch you later.